Hello and welcome to Easy Money with Don Anders. I'm joined by a very special guest today, Tom Hegna. Tom has written a bunch of best-selling books all about retiring, how to retire successfully. Don't worry, retire happy. And paychecks and playchecks is what most people know. And then also on top of that, Tom also had a PBS special all about retiring. So first off, thank you so much for joining me, Tom. I appreciate it. I look forward to these next few videos that we do and just kind of giving some value out to the American people that are about to retire.
Thanks, Don. It's great to be with you.
Yeah. So the first topic we want to talk about, and this comes up a lot, right? So we meet with somebody and they're about to retire. And one of the questions we always ask is, do you have life insurance or would you like life insurance? Now, a lot of people probably think, well, I need life insurance while I'm working because I need to replace my salary if anything happens to me, which is true, right? So that's undoubtedly true. But do people need life insurance in retirement?
Well, again, I don't really talk about my opinions. Let me share with you what the research shows. And this is PhDs from around the world. And if you think about it, Don, you don't get to take any of your money with you. When you die, it's all going to stay down here. And so really what you're supposed to do is you're supposed to spend all of your money in retirement. You're supposed to spend it all. But people, don't enjoy the retirements because in the back of their mind, they think they got to leave their kids some money. Oh, I got to leave some money to Johnny and Susie. I got to leave some money to Johnny and Susie. So they deny themselves a retirement to leave money to their kids. And I tell people, don't do that. You're not supposed to leave any money to your kids. You're supposed to spend all your money. Leave them life insurance because you can do that for pennies on the dollar. And I use me as an example. So we got 4 kids. So one day we're sitting around saying, how much should we leave the kids? My wife said, I don't know. What do you think? I said, well, if we bought a $1 million second to die life insurance policy, name the 4 kids a beneficiary, when we're both gone, they're going to get $1 million tax-free. I mean, that's $250,000 a piece tax-free, plus whatever's left over. I said, let's start there. So we bought a $1 million second to die life insurance policy, name the 4 kids a beneficiary. That policy is completely paid up. Do you know what the total cost of that $1 million policy was? $150,000. So now think about that. For 15 cents on the dollar, we get to transfer $1 million tax-free to our kids. But here's the best part. Who gets to spend all the rest of the money? We do. So I want people to spend their money. I want them to leave their kids life insurance. And that's just one way to use life insurance in retirement.
And I bet your kids appreciate that because now you get to spend money making experiences with them, right? And going and not having to worry about, okay, well, can we afford this trip or can we do this or that? You can actually guilt-free go spend the money and know that there's something left for them. And like you said, and even if you don't do paid up, even if you just pay for what's called like a guaranteed life insurance policy, a lot of times, even if you live to be 100 or 105, you're still going to get double what you paid in, right? Or triple.
Yeah, and again, it depends on the policy, but the whole point is you're using the leverage of life insurance to go to your kids, and that allows you to spend your money. So what I tell, when advisors are working with clients or if clients are just wondering, how much money, I ask them, how much money are you going to leave your kids? And most people say, well, I don't know. I suppose whatever's left over. I say, no, give me a number. Give me 10,000, 100,000, a million. How much would you like to leave your kids? Well, I think we'd like to leave them each 100,000. If they got 3 kids, then I would just run a $300,000 life insurance policy, show them they can buy that for just pennies on the dollar, and that allows them to spend the rest of the money so they don't have to hold $300,000 hostage. Maybe they only have to hold $100,000 hostage or $75,000 or $150,000. I don't know, depending on their age, but they can certainly get it for less than the whole $300,000 that they were planning on leaving their kids.
So another big objection that I hear, Tom, is, well, I'm too old for life insurance. I'm in my 60s. Around my 50s.
Well, here's a fact. People over the age of 60 buy more life insurance than people under the age of 60. I'm 60, and I just, if you knew what my life insurance premium was every year, it's over $200,000 a year that I put into my policy, but I do that on purpose. Now, that's not the one for the kids, okay? The kids, that one was gone. But I also use life insurance to build up a source of tax-free income in retirement because I'm kind of in semi-retirement. I'm trying to load as much money as I can into my life insurance policy so that I can then turn on the income here shortly and get tax-free income for the rest of my life. And right now, I'll be able to get over $10,000 a month tax-free just from my life insurance policy. And so that's another reason. See, I think people need to to start thinking about getting tax-free income in retirement. Because look, we're $28 trillion in debt. The debt's climbing at $3 to $4 billion. Now we got Congress talking about spending another $5 trillion. I mean, this doesn't just grow on trees. Taxes are going to have to go up. We have over $200 trillion of unfunded obligations for Social Security, Medicare, Medicaid, government pensions, military pensions. It's not a Republican or Democrat issue. This is a math problem. We need a math party, okay? Because these parties can't add and subtract. And so what I'm trying to do is I'm converting my IRAs and 401ks to Roth IRAs, and then I'm moving more of my personal wealth into cash value life insurance so that I will have multiple sources of tax-free income for the rest of my life. And I would encourage, your listeners and viewers to do that as well.
And so if you heard Tom correctly, he mentioned two things that are tax-free: cash value and life insurance, and Roth. Those are the two things that are truly tax-free, because a lot of people think that, well, I'm just going to use municipal bonds, or I'm going to use that. That's not truly tax-free the way using cash value inside of life insurance, and then also Roth conversions as well. So talk a little bit more about the Roth conversion. So I said, people can't qualify over 60. Obviously, I knew they can. I see people all the time where, even into the early 70s, it makes sense to do these types of policies. So because what you're doing is you're more focused for the kids, the ones that go to the kids, that's as much life insurance as you can get, right? So what you really are looking for is getting that as young as possible, but you can still get it in your 60s. The younger you get it, the better for the kids. But for the cash value life insurance policy, what you're doing is really dialing back the amount of life insurance, right? So you don't have a ton of life insurance inside of there. You're dialing that back, so the cost of insurance isn't as high, but then you're using that cash value that's growing inside of it. You're overpaying into it, using that cash value, because life insurance is one of the only two tax-free things. Is that correct?
That's correct. And a lot of people who talk about municipal bonds, they don't realize that every penny of municipal bond interest counts towards the taxation of Social Security benefits. And, when I was a brand new agent, I used to help people reduce or eliminate the tax on their Social Security benefits. And I would say 99.9% of retirees out there think tax-free bond interest is tax-free. And they were shocked when I showed them, if they moved that tax-free bond interest, or tax-free bond money into an annuity, that it could reduce or eliminate the taxes on their Social Security benefits. They didn't understand that.
And so the nice thing with the with the Roth, once you're retired, a lot of people think, well, I can't contribute to a Roth anymore. Well, yeah, if you don't have any earned income, you can't contribute to it, but you can convert qualified money over. The nice thing with the life insurance, like you're talking about, using cash value life insurance, is you don't have to convert money, because to convert money to a Roth, the money has to be in an IRA or a 401k or something like that. Any type of money. So money that's coming from a 401k or an IRA as a distribution, money that's in your checking or savings, or just brokerage account, that can all go in to fund that life insurance, correct?
Yeah, so you don't have the same rules for contribution limits and all that with life insurance. You can literally put as much as you want in, as long as the policy is big enough. You can literally put in millions of dollars into life insurance policies. The other thing is, and we're not going to get into it on this call, but even if you have some high income people who say, I can't contribute to a Roth IRA, that's not exactly true. There are things called the backdoor Roth IRA conversion. I've done it personally, and you can do it. You basically put it into a non-tax deductible IRA and then convert that into Roth, and so there are ways to do it, even for high net worth individuals.
I think that's great. So, and then the last thing about life insurance, and this does apply to both sides, is some people say, well, life insurance, it's the main objections that we hear are basically people not understanding that there's different types of life insurance out there. So you might be saying, okay, but the problem with life insurance is 95% of all policies don't pay out. Well, that's term policies, right? So those are what Tom was talking about, are guaranteed. For the kids, was a guaranteed policy. It's going to last as long as him and his wife last. The other objection that we hear is when people say, okay, but the cost of insurance will rise as I get older. Now, Tom, can you talk about that for a second?
Well, that's universal life insurance, and that's
Yeah.
true. And inside of a universal life policy, the cost of insurance goes up every single year. In a whole life policy, that's not true. It's just all one policy, and so it depends on what type of policy you're talking about. But that's why I think it's so important to work with a financial professional. I don't think this is a do-it-yourself. Get on the internet, find it yourself. There's no way I couldn't do it, and I know this thing inside and out, and I wouldn't be doing that. I use a financial professional, so I think anybody who's out there trying to do it themselves, they're going to be very disappointed in their results.
Well, and I am a financial professional, and we still have companies that help us do this, right?
Right.
So we put together a case plans for people, and we still have companies that we call that will help us break down the best options. Okay, here's the benefit of an IUL versus a GUL versus a whole life versus a term. And so very basically the way I would kind of look at life insurance, if you want to look at it simply, is you have term, which is kind of like car insurance or homeowners insurance. You get it, you hope you never have to use it, but it's very cheap, and it's a good way to get covered if something catastrophic happens. Then you have the paid up policies, the guarantee policies, like Tom was talking about for his kids, where you put money in, whether it's upfront or over the rest of your life, and it's guaranteed to pay out no matter how old you get, and it's not going to raise the cost. And then the last part would be a universal life. And so that's when Tom's talking about funding a universal life and having cash value and all that. That's what you look there. So those are kind of the three basic ones that we typically see for retirees. Is there anything I should add into there, Tom?
No, I mean universal life, whole life. They're different flavors of cash
Yeah.
value life
Yeah.
insurance, and I really leave that up to the advisor,
Yeah. And that's the big
to
thing.
pick which is best for them.
There are websites out there where you can just go on and type in your information, get an insurance quote. That's fine if you're going with term. I would still say you should talk to an advisor because they still might be able to get it cheaper. But if you're going with anything that's more advanced than that, you really need to sit down and have them take a look at it. Like Tom said, I mean, Tom, you say that you pay over $200,000 in. You had to go to an advisor to figure out the best strategy to do that. And Tom has written books on this. So if you think that just because you've watched a few YouTube videos and Googled it that you can figure it out, we have an expert telling you that you probably can't. So, well, thank you so much, Tom. I appreciate it. Look forward to speaking to you in the next video.
Thanks, Don.
Thank you so much for watching my video. I hope you enjoyed it. If you want more information about retirement, making money easy, investing in general, please consider subscribing. You can do so right here. And if you want more information and more videos that I did with Tom, go ahead and click here. That's the playlist. We did about 5 videos all about retirement, talk about life insurance, annuities, how to retire happy. I hope you enjoy it. Have a great day.